Thanks for coming on.
Yeah, man.
We appreciate
Great to have
it.
you.
Clarion Partners is a really cool company to be able to talk about, and you have a really cool sort of background and path how you got here and what you're working on at Clarion. So we like to take this away and give us a scoop. Tell us.
Yeah, you started touching on like your history and where you got started. You mentioned you were an architect, but give me some background here.
Sure. So when I was little, I was really passionate about building things. Maybe we all liked Legos a lot, but it was definitely my focus in life, I think. So I really wanted to go to a 5-year architecture program. I was fortunate to go to the University of Notre Dame, did a 5-year program, which means you come out and you can go into your internship. At that point, this was late 90s, and there was that debate between suburbanism and urbanism, and our cities hadn't really rebounded yet. So I was pretty passionate about new urbanism, and worked for a firm called Cooper Robertson here in New York. Alex Cooper was the one who really designed Battery Park City, which if you think kind of in the sort of post-war, kind of modern era, it was one of the first city rebuilds that built sort of streets and parks and buildings defining the edge. So that was a passion of mine. We did a lot of new urbanism, like Celebration in Florida, which it's kind of interesting to look at it now, 30-something years later. The Stapleton Airport redevelopment, those were things I kind of worked on and was passionate about it. Did it for about 3 years. I lost all my hair. Worked very hard. It was stressful, and wanted to explore some other options in the real estate space, and went to business school and then transitioned and actually came to Clarion really after that experience.
So right out of business school, went to Clarion.
Yeah.
And what were you doing right off the bat at Clarion?
So hired as an asset manager, great experience. At that time, we were more regional based, so got to work on office buildings, apartment buildings, retail.
Yeah. When was
really
this approximately?
So this was 2000 or so, right?
Okay.
So right coming into the tech bust, right? So I actually graduated from business school in 2000. So, and real estate was finally kind of coming out of the 1980s recession, right? I mean, it's amazing to think it almost took a decade really to kind of get real estate back to where it kind of should have been.
Well, and what a weird time too, because that's in New York, I'm assuming.
Right.
Yeah, you started. So then you have 9/11, like right after you started. Which
so that was
crazy.
right. You had the tech bust, then 9/11 happened, which I mean, crystal clear in my brain today, right? But it was it was weather-wise a beautiful day, and just
you were in Midtown at that.
In Midtown. Yeah. That's a whole story unto itself.
I'm sure.
I wasn't downtown, so that was nice too.
Right.
Not nice, but. Sorry.
Yeah.
We could edit that.
This guy, this asshole. No, that's great. I'm sure there's so many stories from that time, but it must have been just crazy because you had literally just started, and like you said, we were just coming out of that sort of downturn, and then 9/11 hits New York, and crazy.
It's a crazy time. And then really career progressed doing asset management. We had a series of closed-end, more opportunistic funds, worked on those. And then became a portfolio manager, created a large separate account for a corporate pension fund. And then Clarion started out as a separate account advisor. We were leaders in the open-end institutional space. So for the last 20 years, we've had a lot of funds in that world, the kind of the Odyssey, the open-end diversified core equity funds. And then we saw the world shifting from defined benefits to defined contributions, and wanted to transition our investor base sort of further into the private wealth investor.
Yeah.
So we
and always real estate centric.
Always, yeah. So Clarion been around for 40 years. Today, $70+ billion. We do one thing, right? We invest on behalf of our investors. We really leverage all of those resources for all of our clients. Again, we have some separate accounts still. We have institutional product, and then we have individual investor product that I've been focused on and that we've been working on over the last
which we'll definitely get into. And mostly on the LP side?
Correct. Yeah, we have a large industrial platform, and then we have a multifamily platform as well, where we sit on both sides a little bit, but generally speaking, we are an LP, and think of ourselves as an investor from
Yep.
perspective.
Yeah.
We do some development ourselves, but generally speaking, at the scale we are, you're thinking more kind of as an LP.
Yeah,
Got it.
Absolutely. When you said you started as an asset manager, what was kind of in the portfolio at the time? What were you guys investing in? How obviously Clarion's grown a lot over the last 25 years, especially. But what were you working on at the time? What were some of your early memories there?
Well, I mean, it's funny. Atlanta was in those early 2000s, right? Atlanta was, I think, the fastest growing city in the country, and so we had my early investments were in Atlanta. We had some office buildings, which is interesting to see their lives today.
Oh, right.
And what's happened. But so again, it was a great experience of being a young person, like basically making decisions about leasing and capital for big office buildings in Atlanta, some retail and different type of properties.
Man, Atlanta's come a long way, by the way. Now it's kind of falling.
Well, the shift. I mean, back then Buckhead was everything, and it's still an amazing area. But certainly the whole Beltline creating a more sort of interactive experience for people has really shifted the whole city sort of south a bit, and it's changed it a tremendous amount.
Right,
so.
but I know every year, for years, Atlanta's been like the place that people have been talking about in terms of growth. So
I feel like placemaking has been incredible there, right? They've done a great job.
Right. Okay, well, cool. Well, so you at some point got to where you are today at Clarion, and I think it'd be nice to hear how you got there, and then what products you are working on today, and let's talk about that because I think ultimately, I think a lot of our listeners are going to want to know what your take is on the market and what you're seeing.
Yeah, so as I said, we've been switching kind of our investor base a bit. I mean, we're obviously still focused on our core institutional business, but been trying to work to diversify that. We brought Franklin Templeton in as we recapitalized ourselves about 8 years ago. So we are currently still a partnership. We own part of our firm, but Franklin is a partner of ours as well. Yeah. And again, that was a strategic goal to expand that distribution and leverage the resources of that firm to hit a different investor base.
It's interesting because we had Rich Byrne from Benefit Street Partners on, also Franklin Templeton. So I'm imagining a lot of this helps open up the sort of resources to get to the more sort of retail investor space.
Exactly. So it was 2016 when we brought, it was actually Legg Mason, which became Franklin Templeton at the time. Mm-hmm. And if you think the latest generation of non-traded REITs were all sort of started in 2017. So we were a little behind that schedule. The fund I work on was launched in 2019, but that allowed us to learn from that experience as well. Mm-hmm. So we actually created the first, it's called a 40 Act fund. So it's under the 40 Act fund investment guidelines. And it's a tender fund. So we offer 5% liquidity per quarter. There's some differences between the non-traded REITs and the 1940 Act tender fund. We actually have a daily share price that we strike. It's a bit more of a public fund, so it's actually all the information's on the website, for example, right? So it's just it's
so you can see the NAV
every day,
which is very unique. Or not something that you're going to see everywhere.
Correct. This fund structure has, I think, provided a bit more transparency as we tried to be the next generation. Now, when you try to do the next generation product, it takes a little bit of time, and obviously there was a global pandemic and things of that nature, right as we launched. So it took a little time, but I think we are really now seeing the fruits of the labor over the last 5 years to start to benefit, to see that the marketplace is appreciating, I think, that transparency and the fund structure that we created, and we're starting to see sort of also a capital markets turnaround in the real estate space, which we can talk about as well.
And so, but with this fund, I guess it offers some liquidity, right? Because but there are limits on redemptions as well.
Correct.
Okay.
So the way the space has tried to provide the benefits of the illiquid marketplace, right? So lower correlations, low volatility, the ability to potentially improve your efficient frontier from a portfolio construction perspective.
Right.
But we recognize that people want to know that they can get out of their investment. We're not closed-end funds, right? Mm-hmm. We want to know you can get your money invested the minute you put your money in. And then, you should think of it as a longer-term strategic investment, but obviously people's lives change and they want to get money. So the goal is 5% per quarter or 20% per year. We do it on a quarterly basis of offering basically 5% of the fund. And then there's tools in the portfolio that we've created to help provide that liquidity. But that's exactly right. These semi-liquid products, I think, are still providing generally the benefits that the private real estate asset class can for folks' portfolios. Yeah. But do it in a way where you also have some liquidity over time. But I think it's important, as we've seen even through this last cycle, that people understand what semi-liquid does mean, right?
Right. And a lot of this is geared towards your retail investors.
Correct.
So I guess on that note, I would be curious. I mean, we've talked about this before in the past. What do you think it is about the institutions now going more and more after the retail environment? And I know regulations are loosening some. It seems like that's the next frontier. What are you seeing out there, and how are you guys trying to position yourselves to get that?
Well, I mean, the private markets in real estate in particular have always been much bigger, but we've been seeing this trend throughout private equity and the stock market, right? The private markets are bigger. Public folks don't even on the non-real estate space, don't have to go public as exits anymore. It seems there's now secondary markets. There's other ways to assess capital, and so the private markets, I think, have always been 90% of the real estate market. And from an investment perspective, they're quite different, right? We think of our portfolio as a curated series of lease streams throughout the country based on the assets that we like and where we want to take sort of tactical overweights, right?
Yeah.
You've talked to publicly traded REIT folks. They're great, but they're kind of running operating businesses, thinking about how to kind of grow a sector in a region, generally speaking, right? So I think they're actually quite different from an investment perspective. Not criticizing either one of them, but I think for what they do to your portfolio, it's quite different, right?
Yeah. Well, you guys are much more diversified.
Well, that's right. We're diversified. We're getting independently valued monthly, so it's much more stable, and that type of thing. That's right.
Got it. Lev is simplifying the most tedious parts of commercial real estate financing by bringing it all into one single platform. Use Lev to find new lenders matched exactly to your deal specs, manage all stages of your pipeline, and maintain relationships with your network. With Lev, you can keep in touch with your network, plus connect with over 7,000 active lenders. They're also just launched the newest version of Lev Memo, which uses your uploaded information to generate OMs with the click of a button. See how easy debt financing can be and why Lev users are launching over $3 billion in deals every month. Get started on lev.com today. Got it. Yeah. Should we talk about the type of products you're investing in and what you're seeing out there? I mean, there's a lot changing. We talk about office a lot. We talk about, I'm a multifamily guy.
Rick just lit up when you said office.
Yeah. So
well, I think your last podcast wasn't it about
it was
curated office, which is great. But
we've had quite a few office episodes, which is great for Alex.
Yes, it's great.
But tell us like what you're seeing out there right now, and where are the institutions looking at too? I mean, what type of opportunities are they finding right now?
Yeah. So, I mean, we generally want tailwinds in what we're doing, right? We're not big contrarian plays. I do think, it's great when you listen to your other podcasts and there's folks talking about opportunities that are really creative, and it's super exciting to hear. We're thinking bigger picture in the sense of, to your point, we're trying to create a diversified portfolio across the country in places that we find opportunity. We're thematically driven, right? So no surprise, right? Demographics huge. We have millennials, we have boomers providing two waves in our demographic story, which helps the housing market, right? And provides tailwinds there. And also, as the millennials enter their prime spending years, starting families, right? Like, again, just helps the warehouse demand as well. So kind of theme 1. 2, innovation. E-commerce penetration continues to grow. It's amazing, that pop right during COVID when we were all stuck at home and the packages were coming. Yeah. The penetration now is higher than at those levels, right? So it just continues to grow, providing more kind of warehouse opportunity. Yeah. The health technology is incredible as well, especially as the boomers age. So those are themes we like to take advantage of as well. The shifting globalization patterns just never ceases to be a dull moment these days, obviously. But that investment in manufacturing, the investment in chips, providing new opportunity for warehouse and location, and then just we have a housing shortage. As you know, like just we don't have enough housing units. It's actually a crisis in many ways, but certainly owning apartments has tailwinds from that perspective as well. So you kind of layer all those together. It pushes you to the warehouse sector, the housing sector, and kind of the healthcare, life sciences had some challenges, but the more senior housing, I think, is an opportunity today, and things like that.
So totally
keeping it simple, right? Like it
sounds like warehousing and residential multifamily seems to be two sectors that you and a lot of people are going after.
Yeah,
right now.
I didn't let the secrets out of the bag with that. Right. No, it's just trying to be kind of consistent intellectually in how you look at things. That's right.
It is a big enough field. I mean, the housing shortage alone, that's something all of you guys can tackle, and I still don't think it's going to be filled. So it definitely makes sense. I guess I'm curious to see at what point, from my perspective, I'm sitting here as an operator in New York, so I look around and go, wow, things are really cheap. but you're talking about, more of a macro theme for the entire country, which makes a ton of sense. I'm curious, at what point does it become cheap enough for people to enter back in? I'm sitting
on the
here
office side.
Yeah. Where it can once again be a theme. And I completely get it, right? Like housing, warehousing, it's a much bigger field to play in right now, especially if you're thinking in windows 5, 7, 10 years and in a fund structure. That makes all the sense. You'd be wrong to not go after it.
Right.
How cheap do things need to get?
Yeah. Well, I think, because you've had some good mall people on too, or people that have talked about retail, right? I mean, weren't there 1,000 malls or so in the U.S.? Don't know the exact number.
1,025, and now
And
there's
how many are there left
326. No, I don't know.
But right, like 80% of them are
That's right.
are either gone or something else, or
Yeah.
And there's
challenged.
basically one or two operators really in the space.
Correct,
Right. You got
right.
Simon and I don't know who else at this point.
Right, and I think when you built a pretty idiosyncratic property type in the sense that the mall paradigm was you got your anchors at little to no rent, right, and then you
Right.
made all your revenue with these inline tenants, and when the anchor paradigm disappeared, right, then Apple Store kind of became the anchor,
Yeah,
right, but
right.
it wasn't physically the right type of thing, and so.
And then the mall owners went into actually buying retail brands.
Well, Red Dot kind of consolidated,
Yeah, right.
and then because you had to create place, and it had to be about placemaking, and then
Right.
and so that was a natural progression that's happened over the last 10, 15 years, and I think in office it's going to happen as well to a certain extent. There's great office buildings today that are performing at the highest level ever, right? In New York, you've talked about them, and they're getting the highest rents probably ever or close to. But there's a lot of buildings out there that aren't, right? And so there's winners and losers.
Yep.
And I think the market has to, the supply demand fundamentals have to get back to a more normalized realm, and that means most likely that something has to happen to some of the supply, which is conversions of some sort or something like that, right?
Can there be enough conversions to do something and really make a mark on the supply?
Markets are dynamic, right? And cities are dynamic. Or places are dynamic. We talked about New York since, right? Like we're in the Lower East Side. We're a highly dynamic place over the last 30 years. So I think if you think of cities change and places are dynamic. So yes, it's going to happen. I think it's going to take some time, which is, as an institutional investor, your question is sort of what's that time? It's just, vacancy rates are, I don't know what they are in New York, but overall they're 20+% office-wide across the country, right? So that's a high vacancy rate to find conviction around a sector.
Yeah.
Marketing is an essential part of landing financing, but creating lender-ready materials can be time-consuming and hold up deals. Stop spending so much time building deal books with Lev Memo. Lev Memo uses AI to create clean, lender-ready deal documents based on the information you already have. You can generate a memo in minutes and send it out right away as a PDF or virtual deal room. No copy-pasting or formatting required. And now, for the first time ever, Lev Memo is available as a standalone tool, so you can use it without being a full Lev platform user. Plus, it has added capability to support investment sales teams. Learn more at lev.com/memo. That's lev.com/memo.
I feel like there's a lot of contrarian players out there right now, and who are looking in the office space and saying this is the time.
It's all relative value, right?
Yeah,
Even someone will look at the 20% vacancy and say, okay, that's fine. I can live with that if I buy cheap enough, and that's my stabilized, occupancy. So somewhere someone will make that work.
100%.
Whether it's suburban, city, who knows? And I think a lot of people still have a lot of different opinions that kind of all make sense. Like I see suburban office working in some markets. People don't want to go to the city, or like, why would you? If, you're the accountant, you have 3 people who work for you or 4 people who work for you. Why do you need to travel far if it's 5 minutes from your house, 10 minutes from your house?
Totally.
So, what else gets you excited right now? So you mentioned multi, you mentioned warehousing, you mentioned some healthcare on like the senior housing front, that sort of quasi healthcare. Right? Out of those sectors, what do you think is the most promising right now?
Well, we've also focused with office coming out of the benchmark. There's the alternatives, or we call them extended sectors too, that have come, right? So industrial outdoor storage, self-storage has been definitely part of the dynamic for some time, and then seniors housing, that type of thing. Obviously, the big wave of 80-year-olds are doubling over the next few years. So we've definitely, as a firm, focused on these alternative sectors, and that's been a big push for us. So as a fund, we've invested in industrial outdoor storage recently. We've done some senior housing investment, and we've definitely sort of transitioned a bit into those sectors. Those are, again, thematically completely consistent, and even part of the industrial space to a certain extent, just a little bit different way to look at it.
Yeah.
So those have been big opportunities for us. I guess I think you have to overlay pricing too, right? So there's obviously demand, and there's supply. We didn't talk much about that yet, but supply is kind of way down, right? So that's a good position from the fundamental perspective. But then you have to say, how much can you buy these assets for today, or what are they worth? And again, the themes that I've been speaking about aren't secrets. So people have different opinions about what that potential growth is going forward, and therefore the price they want to pay for something. And that's really kind of been the challenge, right? Is trying to pull that market together to understand the right pricing for the right growth, kind of given all these different factors.
I'm really impressed by firms like yours and people like you in this position where you guys are a behemoth, and there's a lot of other behemoths out there. There's so much money going into the space. It really is tough to gauge. The limited supply is a phenomenal tailwind, but like I'm always so scared of like, what does that curve look like? It's impossible to predict almost. You can. I mean, what gets you guys comfortable? Like what?
Well, new supply too, right? We've seen new supply tends to be the greatest moderator of rent growth. So that's always the hard balance too, because you want to be in growth markets where people are moving to and it's growing, but you also, if you oversupply, especially in the short term, it can obviously really make that rent growth projections more challenging. So it is a story of supply and demand, and I try to make that point. I think people talk a lot about growth, which is really important, but I think price and balancing growth and supply is the concept that's kind of hardest to understand. And we have a lot of research, and we do our best to underwrite every submarket to your question, and try to come up with. We have our own proprietary rent growth. And that's kind of the arbitrage, I guess, is what does the market rent growth think versus what does our proprietary rent growth think, and how do you take advantage of that?
That's what I was going to ask, because I feel like the markets are very efficient, particularly when you get to a certain level. And, in multifamily in Texas, I will tell you, I mean, the only way, the institutional product is getting done right now is you're banking on 4 or 5% rent growth in year 2 and 3. And that's it. I mean, otherwise you're in negative leverage, and it makes no sense.
In a lot of industrial also, right? Like the reason why so many of those properties got sold at 4 caps is because there was enough demand, packaging, shipping is going straight up. So in 2 years, it's a 7 cap. Or it's
right. Well, in that case, you had those. A lot of times you had in-place leases that were, your at market cap rate was higher because you had maybe 2 years left on a lease, and so you knew if you bought it at a 3.5 today, it was a 7. The market rents were hopefully proved. Now those could change, obviously, I understand, but like versus multifamily generally moves. There's always a loss to lease, but you're generally moving within a year to whatever the current market rents are for the most part, right? So
ideally,
you shouldn't have that much of a lag that you had in the industrial sector. But I think the driver of low cap rates in multifamily is expected rent growth over the next few years, and that's where you have to.
That's where the research comes in, and that's kind of the secret sauce with companies like Clarion. I guess that's why you invest so much in.
Or you try to pick the right markets where research. We see that pushes you to make those decisions. That's
Rick, educate me a little bit on the iOS play, because I know that a lot of people are getting into it now. Like, is it the same kind of theme as it is with industrial, like just traditional industrial? What's the exciting factor of iOS?
Well, I think it's a bit more dislocated of a market, so there's smaller opportunities, so yields are a bit higher. They're often not as attractive as properties, right? Like they're more storage yards, so I think there's a little bit of an intellectual hurdle there that people just viscerally see them and they don't look as beautiful as a 1 million square foot glossy warehouse. But from an investment perspective, they're generally higher yielding and lower capital requirements, and this is the part that's, the thesis that is somewhat counterintuitive, and I think there are actually supply constraints in it, and that sounds sort of backwards in the sense that it's a piece of land, but actually a lot of communities don't want storage yards, and so from a zoning perspective, good infill locations, I think we've found there to be more supply constraints. Zoning is hard, right? Because a lot of communities don't want these things, so that's part of the opportunity. But you have to, on your underwriting, be really thorough about making sure you understand what the zoning requirements are. That makes sense. That's a risk to the investment as well. Is that supply constraint is a regulatory one, which could be a concern potentially. So you just have to think that through.
Yeah.
But when you're talking about zoning, are you seeing people like, create new outdoor
No,
storage?
I think they're going the other direction generally, right? Which that's the supply constraint story, right? They're not creating new because most places don't necessarily want it, right?
So you're saying more so. I have heard a few operators talk about as the covered land play, right? Like that's their entry into development sites over the years. I mean, I don't know how much of that there is at scale, but what are your thoughts around that? Like, does that?
I think that makes sense
part of the
too.
theme?
Although I think the sites tend to be a little smaller, so you'd have to be comfortable building. You know, you're not going to build generally large, big warehouses on these sites. They're a little bit smaller. But I think that's a great play too, right? Is to get infill land. It's got the right zoning and get a nice income yield on it, and then have optionality at the end of the day, right? That's always a good investment thesis.
Yeah.
Rick, how do you, as managing all of this, how do you decide how to allocate to what segments? What's the process behind that? I feel like that's got to be difficult.
So when you think of portfolio construction, especially on the semi-liquid product, first we have a sleeve that invests like about 20% of the fund is in commercial and residential mortgage-backed securities, and that's to provide that 5% per quarter liquidity. We obviously have a credit line which helps provide liquidity as well. We actually do private credit. We lend on investments too. So not only are we making investment ideas about like regions and property types, but also do we want to be a lender in this situation, or do we want to be an equity owner? And that's actually helped a lot with the pricing that we've been talking about recently, right? Because you can get quite compelling income yields today, following the same themes you like, and it's been a nice tool in our belt to really help supplement our income on our portfolio and provide some stability and diversification. And then about half our portfolio is equity investments. And so, sort of your question, I mean, really, you think about the portfolio as a whole, and you're thinking about where you want to overweight. So we know the ranges of the sectors we'd like to overweight. And then you think of regionally where you want to be. And so it's a blend of thinking through risk and return for each investment, and then how each of those income streams complement the existing portfolio. And obviously, if you have leases rolling in a certain year, you want to then, and some investments might be more of an income play and stability, and some, hopefully, maybe you get a little more growth out of those incomes. So really, it's
is it kind of an art and a science?
I mean, I think it is. I mean, you need to, and then there's also just leveraging resources. Like you then have to go hunt and find the deals or the investments to make, right? And so you have to make the judgment of which ones sort of fit the puzzle the best, and which ones are the best kind of market opportunities today, given all of these factors.
It's a lot, right? To me, it's like your credit space, equity space, product type, region, state, city. Like, I mean, there's just so many different
risk, and how that, like, the convexity of that over, the life of the project, where it is.
Is there an AI component here
there has
that
to be at some point.
You guys are using? I mean,
I think we're using more of the tools that are out there today, and we're trying to. I mean, everyone's doing the same. I think to a certain extent of trying to use all this information we have. We have a ton of data, having the tenants we have. You can obviously buy more data. I mean, that's why we can do this today. I mean, like it's a lot to also value all your assets monthly, right, and come up with a daily share price. And the technology behind, whether it's AI or just the whole infrastructure technology of working with a Franklin Templeton, has allowed us to do this today at a price that we think is fair, versus, historically it was hard to do this type of investing at the smaller scale to the individual investor on an efficient manner, right? So those tools, yes, we're trying. I think we're all doing different things. It's certainly part of trying to be a better investor today. And it certainly makes you more efficient to a certain extent. But then the demands on the other side of what the products are requiring are pushing you as well. So it's not like we're only working 2 days a week now because AI just the robot does the work. Now, building the brand, telling the story, getting to the individual investor takes a lot of time, which is the other kind of side of it.
Makes sense.
You need an army of people.
Yeah,
and I mean, that's why, again, not to, the whole Franklin, I mean, I know Rich spoke about it too, right? And that's been a big transition. Franklin invested in a group called Alternatives by Franklin, which are really focused on BSP, Clarion, and Lexington on the secondary side. And they've invested in a huge team to help sort of tell these stories as well, right? Because it is a lot to explain. These things are nuanced and complicated, and
Right.
But the whole world is sort of seemingly headed in this direction.
Yeah. Yeah.
So going on off that theme, do you see the firm kind of raising more funds, or is it still chasing separate accounts? Like, what's the real capital strategy, or what are you guys looking for? What in an ideal world? Like, if you could have more of one thing, what is it?
Well, I certainly think if we were 100% institutional capital 6 years ago, we're definitely, at least dollars raised, hopefully heading to be more kind of 50-50 going forward, right? So like, I think the firm is definitely headed in the private wealth space. If you talk to our CEO, if you talk to the CEO Franklin, I mean, I think that's a clear message that's been kind of out there, and that's where all this work has starting to pay off. But we have this one sort of broad diversified fund, Clarion Partners Real Estate Income Fund. We've done some QZ investing, and then I think as we grow our platform, we'll look to find more products. We have a European team which we're looking at product as well. So I certainly looking to understand market opportunities to take advantage of the distribution network and the opportunity that's here.
Yeah, that makes sense. Well, just another question, just on the credit space. I mean, there has been so much volatility. How are you approaching credit today? What are your thoughts on it, and where do you see the opportunities?
So, about a third of the portfolio is originated loans that we do as part of this strategy. That is focused on the tailwind, so similar themes that I spoke about. So generally looking at sort of multifamily, industrial, actually some seniors in iOS too. There's been opportunities there as well. So again, we're not trying to do something different in that space. We're really trying to just take advantage of it's been the dearth of capital generally. Particularly, fortunately, we've been raising capital and investing over the last 18 to 24 months. This opportunity is becoming a little more crowded today, although I still see real opportunity. But certainly over the last 18 to 24 months, particularly when the equity markets were volatile and there wasn't a ton of transparency on where pricing was, the ability to make these investments was a great tool to have in our belt, and it's been a great diversifier for the portfolio. Going forward today, it's probably almost 50-50 of how we're sort of seeing opportunities, and that changes sometimes monthly or daily just on where the opportunities kind of are coming in based on different sways in the capital markets.
Yeah.
But the 10-year has been what? It's been kind of between, for the most part, 4.25 and 4.5 for the last 6 months or so, right? So starting to be stability there, which I think is helping kind of all of these markets. And if it does go down, again, I'm not an interest rate I can't predict
no one
them.
knows.
Right,
sure.
But I mean, I think the stability I think is most important, and then if we can start to see it head down a little bit, that's a good thing too certainly for the equity side. But even on the debt side, I think to know refinancing can be done in a little more efficient manner.
Still good opportunities.
Yeah.
Justin, being in your shoes as an investor, are you kind of get in first and early and get the upside, or are you more of let's see how the space bakes out and try to reap the benefits from there? Where do you lean?
Yeah, I mean, I think it's a great question. We live in a dynamic world, right? Where we talked about malls, we talked about office buildings. These sectors are changing. I think that's what's exciting about our space today is you can't set it and forget it. You need to make sure you're selling at the right time if you're seeing something change. So I think, but we're institutional capital, we're stable capital. We're not trying to find big new opportunities that are risky, right? So we try to be early. I think we're trying to be early in industrial outdoor storage. I think we were early into sort of the life science space, and we've tried to be. We were big and early into the warehouse sector, so we try to be appropriately early, if you want to think of it from an institutional perspective, and then you try to make sure you're asking yourself when do I sell and when do I get out too? Because is the world changing on me there? And we're not perfect at that, but that's what we try to do.
The news is important, but if you're a busy real estate professional like me, you don't have time to skim through dozens of dry and ad-filled media outlets each day. That's why I read the CRE Daily. It's a free email newsletter that cuts through the clutter and delivers concise, witty commentary on the latest trends and transactions in commercial real estate. If you're a commercial real estate professional, you owe it to yourself to try it out and stay on top of what's happening in the industry. It's only 5 minutes a day. Visit CREdaily.com to sign up for free.
Yeah.
Yeah.
Outside of real estate, or you can include it in the topic, what gets you hopeful today? What are you excited to see over the next year, 2 years? Could be anything.
Hey, I think
This is the toughest questions.
You got a lot going on, right?
Yeah.
We got, we are not going to get political because I'm sure Clarion wouldn't be too happy with that. Although
listen,
it'll
totally
get
up
good,
to you. I
it'll
don't
get
care.
good ratings. So please,
Ratings are live.
Yeah, we're rated.
Where
You didn't
are
know
we
that?
between CNN and Fox? Are we in the middle?
We actually probably have more viewers than CNN, but that's
well, that's your demo. Sorry, I'm not going to go there.
Yeah.
So I think there's lots of opportunity in the real estate space. We're entering a new cycle, right? So we've seen now almost 24 months of values adjusted down. We've now had 4 quarters, I think, of positive returns in the private markets. We talked about the demand drivers going there. So you have good demand drivers. You have really low supply. And we've seen, I think, values turn. And with that stable tenure that we spoke about, I think there's real opportunity that entering a new cycle, historically, real estate has rebounded to replacement cost in the early years of a cycle. And I think the human brain tends to sort of look backwards and understand the world that we see. But I think if you look historically, entering a new cycle can be an exciting time for our industry. We don't call cycles per se, but I think if you put all those things together, investing in private real estate in a thoughtful, approachable ways can be a good thing, and it's exciting.
So where are we in the cycle right now?
Because
we all know. Yeah.
Exactly.
No one knows.
No one knows. No one knows what the tenure is going to be, and no one knows a lot of things.
But if you were to guess, where do you think?
I think if you look historically, right, real estate has had over the last 25 years. I think there's been 3 or 4 years of negative return, and in those time frames when returns adjusted down, kind of below replacement cost, in the years after, real estate tended to perform a couple hundred basis points higher than its long-term average. That's an historical look, right? And then you look at rates stabilizing, values stabilizing, and then you look at fundamentals with the exception of office, and we went into that a bit already. I think we're at the beginning, early innings of a new cycle.
Yeah. I think that's a pretty fair consensus that we're all kind of feeling. So
listen, for the last 5 years, definitely the heightened talks of recession's coming have it's been the theme in everyone's conversation. But was it a mini recession? Was that the pandemic? Was it 2 years? Is it still coming?
Right.
I don't know. I definitely think we had that soft landing that nobody thought we would have.
Yeah.
It seems like it's pretty big at this point. And to what Rick said, given what the last 4 quarters looked like and just where values are kind of high level across the board. There's that chart that KKR put out. I think Blackstone made their own version and was like the S&P 500 credit, private credit, right? Every opportunity was kind of in 80 to 90% of its historical peaks in 2019, and then real estate's down at 24% or something, 30% of where all valuations are. So it'll be exciting.
And CRE Daily keeps coming out with a fear and greed index, and you can kind of see slowly but surely the quote unquote greed side, just the people just being more bullish on where the market's headed is coming up. So
you know what Buffett says, now it's time to be fearful.
That's right. That's right. Exactly.
So maybe the recession is coming. Who knows? Stay tuned. We'll figure it out.
Cool, Rick. I guess before we sort of wrap this up, tell us. I mean, we have our listener base is interesting because we have a lot of institutional followers and those who have been in their careers for 20, 30 plus years. But we also have a lot of recent college grads. It's a tough market right now. I mean, we get reached out to all the time from people graduating who are looking for stuff and they can't find anything. What would be your recommendation for finding a career in your space? What advice would you give to recent grads?
First, I think all experience is kind of good experience, and I don't mean that in a funny way, but I mean, whether you're a property manager, I was an architect, right, or you asset management. I think people think of a career I should go do acquisitions in this, which is great, and they're all great experiences. But what's cool about real estate and trying to get the judgment to make good investment decisions we've been talking about this whole time is really every experience you have kind of goes into that judgment factor, right? So whether it was asset managing assets 20 years ago or thinking of designing places, whatever, 25 years ago. Those are all go into your brain to I think hopefully build a judgment pool that helps you make good decisions. And so, if you're young, I think be open-minded to different opportunities and if you love real estate and want to do it, you can be a broker, you can be a property manager, you can be a research analyst. There's tons of jobs you can do, and I would just encourage you to be open to them. Now, you have to look at your career as it goes and make sure that those junctures, like if you're doing something for a bit, if you do it for too long, it gets harder to transition.
Yeah, when to pivot.
Right,
Yeah.
but when you're young, I think all experience to a certain extent is good experience, and I would just encourage people to think that way.
Yeah.
I think you look at your experiences and I mean, who knew in architecture, probably the greatest thing I learned was telling stories, right? Because in architecture, the culture was you didn't sleep for weeks, you drew all your drawings and you pasted them on a wall, and then people came in and it was called the criticism, it was your critique, right? And it was hard, right? Because you were exhausted, you put your heart and soul on a wall, and people's job was to tell you what a bad job you did. You learn quickly to tell a story that worked because people focused a lot of ways more on the story you told than actually what you drew.
Yeah.
And you learn to sort of be able to take criticism in a constructive manner, which, by the way, in my professional life has been, two huge benefits. So, again, all these experiences take things to grow. I think be open-minded, but then also when you're in them, then understand when to pivot is really important too.
Yeah.
What an interesting thing that I kind of wish we could incorporate in every facet of every job right now.
What's that?
A way to post your work product and have people critique it. How fast would people's egos
Well, it's
come
funny.
down?
I don't know about if you guys have been following this, but
That's awesome,
with AI and all the language models like ChatGPT, it's overly positive.
Oh, right.
So it's like that's a great point, Jack. Oh, Jack, that's fantastic. And
You
then
have to tell it to be negative.
even when you correct it, it goes, oh.
Yeah,
You're absolutely
way
right.
to pick up on that.
Yeah. So
Are you nice to ChatGPT when you ask the question, or are you just straightforward
Jack says
or
please and
normal?
thank you.
just
Did you say please and thank you?
They say
Jack says
not to
please.
do that because every time you even say please, you're destroying a tree somewhere with the energy
extra
that it
energy.
costs.
Just the extra
Yeah,
Wow.
But they say it's overly positive, and therefore we might have a whole generation of people who do not know how
They're
to take
egomaniacs.
criticism.
Now they have this constant validation, participation trophies, ruined everything. Anyway, Rick, awesome having you. It was great to get to know you and see the world through your eyes a little bit.
Thanks for coming on, Ray.
Thanks, Alex. Thanks, Jack. It's great. Appreciate it.